Hi, good evening. People are still joining, I think.
Good evening, sir.
The 13 there, but in the rest of time, in the interest of time, let me start. Otherwise, we are wasting our time. So let others join. We'll start. So we were discussing about market risk. We started the paper and we did few questions up to 10th question, I think. Let's continue from there and then we go to the next one. Let me share the screen. Right? Hope you can see the screen. We did up to the 10th question. So now let's move on from there. So you start with the question number 11. But I only got 6 responses. I was wondering, we have about 13 people, or only 14, yeah. Anyway, let me start, otherwise time is ticking. The question is, a fund manager believes that the share price of a large constituent of the fund's portfolio is overpriced and enters into a put option to protect the fund against the expected price fall. This is an example of diversification hedging volatility market risk limits. That's the question. So before that, let us first understand what this transaction is about. What does it say? According to this, the fund manager believes that the price, right, of a share is overpriced. When the price of a share is overpriced, what can happen? There is a possibility for the price to fall, right? There's a possibility for the price to fall in near future when the prices get adjusted to the intrinsic value. Sometimes the current market price probably, let's say, is 150. And if you feel it's overpriced, which means there's a possibility for that to come down in the near future. Maybe it might settle at 100 or something. So there's a risk for the people whoever is holding the shares, because when they are trying to sell the shares, the prices may be lower than what they bought it. So that is when we look at things like put option. A put option is an instrument that gives the right or entitlement for the holder of shares to sell that shares at a particular price agreed as per the option. Let's say if you have agreed to sell the shares at, let's say, 140, right? That means there is an option for you to sell it at 140, even if the market price falls. Let's say if the market price falls down to 100, you still can sell the shares at 140 by using the put option. So therefore, you will not be exposed to the fall in price. And that is what this arrangement is all about. So the question is, what type of a arrangement is that? Right? Is it a diversification, hedging, volatility, market risk limits? So it's obviously a hedging mechanism. Why we call it a hedging? That means when you have, by investing in another instrument, you have mitigated the risk of fall in price, right? That means your price will anyway fall in the market. Then you have an alternative option to sell that at a different price using this. So the correct answer is B. Majority of the respondents have given the correct answer, but we still have people with different answers. So the question 11 answer is B. Let's go to question number 2.
So would you mind explaining the volatility and market risk limits as well?
Sorry?
Volatility and market risk limits?
Yeah, volatility is not a tool, right? Volatility is the price movements. That's a component of risk that we discussed. Volatility is the fluctuation of prices up and down. And market risk limit is when you have specific limits set for different transactions. For example, that is even when you look at your investment portfolios, you keep a limit, right? You won't go and invest beyond this in this industry. So you have a limit there, a percentage or a rupee value. So likewise, all these different kinds of limit you impose to curtail the exposure is called the risk limits. And diversification, we all know what it is. And hedging is, as we know the theory, making an alternative arrangement to mitigate the impact of a incident of one instrument. Right, that instrument remain as it is, but you have an alternative arrangement. So like here, you have the share investment, and at the same time, you buy a different instrument called put option to mitigate the risk. Right? Okay, let's go to question number 12. Right, I've got 9 responses by now. Right, let's see. 12. Which one of the following best states the value at risk measures? The likelihood of loss, the probability of returns, the uncertainty of return, the maximum loss. Even I just discussed something different. Value at risk, in very simple terms, you're setting the limits. You're setting the limits. That means you are defining the maximum loss that the organization is willing to absorb in a particular case or instrument. So it is setting a limit for loss, right? Maximum loss. So the idea is the last one, the maximum loss. The maximum loss, D. So I think 8 respondents out of 9 have given the correct answer. So one is out. Right, let's go to the next question. 13. I have 4 responses by now. Right, it reached 7 now. Let me see. 7 responses. Question. Which of the following is true about the relationship between the mean and median? Mean and median. So what is mean? Mean is the midpoint, the average, right? Mean is the average of a given set of numbers. Mean is the midpoint when you arrange the numbers in the ascending order. So technically, the mean is more robust measure of central tendency. The mean and median are the same when a distribution is skewed. The median is influenced when there are extreme outliers in the data. Technically, the median is more robust measure of central tendency. So what's the correct answer? So I can see the responses. Yeah, 8 responses, majority saying D. Yes, the last one sound more appropriate, right? More appropriate and accurate compared to the others. And as you can see, there are some false statements as well. So the correct answer is D. Right, let's go to the next question. 14. I've got 7 responses. Let's see. Which type of market boundary risk would usually be associated with the holding of equities? When you hold equities, which type of boundary risk are involved? Credit risk, operational risk, volatility risk, settlement risk. Right. So I can see out of the 8 responses, yeah, majority says C. Yes, for equity, it is the volatility risk. The price can be fluctuated in the market up and down. So that's the main risk compared to others applicable here for equity. The correct answer is C. 6 out of 9 have given the correct answer. Correct answer is C. Let's go to question number 15. Right, I've got 3 responses. Is it a difficult question? Let's see. 15. The standard deviation of shares return is 0.5% and the mean is 10%. Approximately what percentage of the returns of the normal distributed data will be between 9.5 and 10.5? Okay, let's try to understand the question. It's very easy. Let me draw this is the normal distribution curve. Center point. This is risk, that is standard deviation we put. center, right? Midpoint is 0 because this is the mean, right? Right. In this, return 0.5. So sorry, deviation of the share return is 0.5%. Mean is 10%. That means here it's 10%. Standard deviation is 0.5. So we have 1 standard deviation, 2 standard deviation, 3 standard deviation. Yeah, right? So same like this. So 1 standard deviation area is, that means if midpoint is 10%, 1 standard deviation area is 10% plus 0.5 and 10% minus 0.5. That means 9.5 up to 10.5. That is standard deviation 1 range. Standard deviation 2 range, 10% plus 0.5 into 2. That means 11%, here 9%. Standard deviation 3 range, 11.5%, here 8.5%. That is the range. So standard deviation 1 range is 9.5 and 10.5. That is this area. Between 9.5 and 10.5, we know generally 68% is there. Standard deviation 2 is this area up to this point, right? So here it is 9%, here it is 11%. So between that range, you will get 95%. Standard deviation 3 range is here, this area 8.5, here 11.5. Between 8.5 and 11.5, we have 99%. That's the explanation to this. Now the question is, what percentage of returns are distributed between 9.5 and 10.5? 9.5, 10.5 means 1 standard deviation away. So 1 standard deviation away means 68%. So the answer is B. Right? That's how you get the answer.
So would you mind explain it with an example?
Example. So okay, this given question is an example anyway. So it says it talks about the return. So I'll give you a different example to make it easier. Let's say we are talking about the okay, we are talking about the height of the students in a class. You have 100 students in a class. You are talking about the height. So you have different heights: 4 feet high student, 4.5 feet high students, 5 feet, 5.5, 6 feet. Likewise, you have. Assuming that the height of the students are normally distributed, that means you have a higher number of average students and you have a smaller number of very high or taller students, and a similar number of shorter students, right? Then let's say the range, the lowest is 4 feet, the highest is 6 feet, right? And you identify the average height of the students is 5 feet. And when you calculate the deviation, standard deviation, right? Standard deviation, we know how to calculate that. Standard deviation is 6 inches. That means 0.5 feet, 6 inches. So if you look at this normal distribution, right? Let me erase this, right? Right. So if you look at this normal distribution curve, standard deviation 0 level, average height is 5 feet. Right. So standard deviation 1 means, standard deviation is 0.5 feet, that means 6 inches. Standard deviation 1 range means 5 feet plus or minus 1 standard deviation. That means 5.5 feet and 4.5 feet. So this is the standard deviation 1 range. So according to this definition, 68% of the students, that means 68 students in this class, technically, should be between 4.5 and 5.5. Their height is 4.5 and 5.5. And 95 students, the height of 95 students out of the 100 students in the class, their height is between 6 and 4, right? So 95 students you will find in the class whose height is either 4 feet or up to 6 feet, between these two. So 99% of the students will have up to 6.5 and 3.5, between 3.5 and 6.5, 99% of the students. That is the idea.
Thank you, sir. It's very clear.
Okay. So the answer here is B, right? Answer here is B. Question number 50. Let's go to the next question. 16. Okay. And I've got 7 responses. Right, let's see. The question is, an investment manager has entered into futures contract to hedge the risk of certain investments that are held in the portfolio. If the hedging does not operate as expected, then this may result in, right? That means if the hedging doesn't operate, what will happen? Basis risk, equity risk, volatility risk, liquidity risk. Right? So the correct answer here is the basis risk. We've discussed, but let me recall that basis risk means when you hedge your risk exposure. So what happens is you have an instrument, and then to avoid the impact of any eventuality, you hedge. That means you get another position that will have an offsetting impact. That's what we say when we discuss the basic example. When you sell umbrellas, during rainy days you sell it, but during sunny days you might not be able to sell it. So to avoid that impact, we also sell ice cream. Then during sunny days you have ice cream, during rainy days you have umbrella, so that the impact of drop in sales in one is mitigated through the other. So that's how we generally do that. But what the basis risk is, when we have that kind of an exposure, we are looking at an alternative instrument or position to offset the impact. But if the movement of the other instrument does not follow or move in the opposite direction as planned, then your hedging will not work as expected. So that is called the basis risk. Right? That means when the offsetting exposure is not fully covered by the hedging deal or hedging mechanism, you are exposed to that risk anyway. That is called basis risk. So the correct answer is A. It's a technical definition. Right. Let's go to the next question. Question number 17. But I've got 9 responses. Let's see. The firm is assessing its VR model by testing the impact of simultaneous changes in general interest rates, individual stock prices, individual stock volatility, and correlation coefficients. This is an example of backtesting, regression testing, stress testing, and scenario analysis. Right? So multiple changes. We've discussed there are 2 things we talk about: stress testing and scenario analysis. And when you have multiple changes, it's a scenario analysis. And if you look at one variable at a time, it's a stress test. Very simple. So the correct answer is D. Let's Right, I still have only few responses. That's what I was holding on. Anyway, let's see what the question is. A firm is assessing a VR model by testing the impact of simultaneous changes in general interest rate, individual stock prices. No, sorry, that's the one we have looked at, right? So 8.8. Which statistical tool is used to analyze the relationship between two variables and how a variation in one will affect the other? Optimization, probability, value at risk, regression analysis. It's again very obvious, right? The relationship between two variables we have looked at in regression analysis. Majority of you have given the correct answer, but still I can see some have not got it. Right? The correct answer is D. Right? Correct answer is D. So if you can respond faster, we can move faster. Right? Let's go to the next question. Question number 90. Right, I have only 6 responses by now. Let's see what the question is. 19. An investment fund is concerned that an announcement of economic data may precipitate a fall in the US market. Therefore, buys put options on the S&P 500. This is an example of very easy. We have discussed similar thing. This is an example of hedging, right? Hedging. We discussed similar example earlier. So the answer is B. But I can see still there are a few people who have given incorrect answer. Right? Answer is B. Let's go to the question number 20. Right, I've got 6 responses. Question number 20. Let's see. A UK investor bought shares in a US company last year, and their gains on the share are not the same as the underlying price increase seen in the US market. This is likely to have risen due to currency risk, liquidity risk, volatility risk, interest rate risk. I think it's obvious when you are in two countries, according to this example, it is due to the currency risk. That is A. Right? Let's go to the next question. 21. Right, I've got 6 responses. Which Bayer approach involves generating a random set of results from identified risk factors? Backtesting, horizontal simulation, parametric testing, Monte Carlo simulation. I think we have discussed this one as well before. It is Monte Carlo simulations. I think we have discussed, I think, yeah, most of you have given the correct answer. It's Monte Carlo simulation. It generates random numbers, the number of iterations you run. So the more you run, the more closer it becomes when it comes to the accuracy. Right. It's D. Let's go to 22, question number 22. Right, I've got 6 responses only. Which of the following portfolio construction technique is used to obtain the best expected return from the right mix of correlation and variation? Active allocation, optimization, stratified sampling, replication. Right. I think we discussed this also. So the correct answer is optimization. That's mean variation optimization. We discussed that. That's where you get efficient frontier to get the highest return for the given risk, lowest risk for the given return. We discussed that. mean variation optimization. So the correct answer is B. Right? Question 22 B. Right. Last question of this paper. Question 23. But I've got 6 responses again. Let's see what the question is. An investment fund investing in overseas equities has entered into a hedge to manage the risk of adverse currency movements. As a result, it is exposed to the additional basis risk, currency risk, volatility risk, liquidity risk. So we discuss when you entered into a hedge, right? When you invest in overseas, you're exposed to currency risk, right? The question is about additionally, what risk are they facing now? Because there's a hedging also involved. When hedging is involved, the risk is when the hedge doesn't happen right? Efficiently when it does not cover all the risk. So we discussed that part where hedging instrument does not cover the risk as planned is called basis risk. Therefore, in this case, the additional risk they are facing is basis risk. That is A, right? That is A. Question number 23, A is the answer. Right. So with that, we conclude the paper. Yeah, we conclude the paper. So what I suggest is, now it's 8:30. Let's go for a break and come back. So we are now continuing with the next topic that I think is investment risk. We'll get back after the break. But I hope most of you all are back. Let's continue. Now, the next topic we have is investment risk. Let us now discuss the paper as shared. Right. So let's go to the question number 1. But I've got 6 responses. Let's see what the question is. Which one of the following methods. Which one of the following methods involves taking an offsetting position to reduce the market risk in a portfolio? Hedging, short selling, optimization, diversification. We discussed similar question before. So the obvious answer is hedging, right? We are taking the offsetting position in the portfolio to meet the gap. Unfortunately, in the given answers, I can see out of 7 responses, only 3 people have given the correct answer. The answer is hedging. A. Right. So let's go to the question number 2. Right, I still have 5 responses. Is it a difficult question? Let's see. If an individual invests £10,000 into a 5% coupon bond at a price of 200, the nominal income return would be 250,510. So you need to first understand the question here. Invest 10,000 into a 5% coupon bond at a price of 200. So when you invest 200, you need to understand there's a standard price, right? If you have missed this part before, understand that when we talk about bonds, there's a standard price that they generally issue them. The nominal price of a bond generally is £100. It's £100. So, but the companies can sell it at a premium or a discount depending on the market situation. So in this case, what they say is individual invest 10,000 into 5% coupon bond at a price of 200. That means you are investing 10,000 at a price of 200, which means the number of coupons you get, right? In this case, 10,000 divided by 200. So the number of instruments you get, 10,000 divided by 200. But the nominal value, as I explained to you, right? Nominal value is 100 instead of 200. So therefore, the nominal value of this instrument is £5,000 because there's a 100% premium in this case. So when you give interest, you pay interest or coupon on the nominal value, not the market value. That means this 5% will be applied on 100. So altogether 5,000. So 5,000 into 5% is 250. So the question is the nominal income return. So nominal income return is £250. Right? The question is about how much is the return. So therefore, the correct answer is A. Right? Correct answer is A. Most of you have given 500, third one C, but that is wrong because the question is about what the nominal return. Nominal return is the return is paid on the nominal price of the shares, not the actual price of the shares. The nominal price is the standard price, that is £100. That's a standard. Whatever the question you get, please don't forget it going forward. Right? The answer is A. Right. Let's go to the next question. Question number 3. Right, I only have 4 answers yet. Is this a difficult question? Let's see. Only 4 answers. Let's see. Right. An investor places 10,000 into a fixed rate account paying 3.25 per annum for a fixed period of 3 years. Inflation is expected to run at 2% for the period of the term. What will be the nominal balance of the account at the end of the term, assuming that interest is reinvested at the same rate? Right? So 10,000, 3.25. They're asking the nominal balance. Right? So that means you have 10,000. How do you calculate this ratio? Let's look at it. You have 10,000 into 1 plus r to the power 3. That's how the normal way of calculating the interest rate. Right? So r in this case 3.25. In other words, you can calculate it by taking 10,000 into 1 plus 0.3, that into 1 plus 0.3, that into 1 plus 0.3 3 times. That's also, you get the answer. But you know, you can use the calculator, or you can use your phone, the power mark into 3. So to get the factor here, that means 1.0325 to the power 3. What is that figure? Right? That is 1.0325 1.0325 to the power 3. I get 1.1007. 007 is what I get. That's the answer. Right? That means 10,000 into this is the answer. So this is what I get. B. Right? So how many of you got the correct same answer? As I can see, 3 out of 6 has given B as the answer. So that's the answer. Right? B. Question number 2, answer B. Let's go to question number 3. Sorry, question number 4. So the previous answer was for question number 3. Yeah. Question number 3, answer B. Now we are at question number 4. Right, I've got 5 responses only. Right, let's see. Question number 4. Which of the following details are likely to be included in a fund's investment mandate? Yes, investment mandate. What fund will aim to beat and minimum error in tracking the benchmark? The withdrawal conditions and the date it will be wound up. The minimum error in tracking the benchmark and the withdrawal conditions, whether it can be hedged, and what fund it will aim to match the or beat. Now, it's a kind of a tricky one, right? The question is about which of the following details are likely to be included in a fund's investment mandate. It's not about the fund's overall investment mandate. Then the user need to understand some of these things, right? So there we get the last one, whether it can be hedged and what fund it will aim to match or beat. That is important in terms of the investment of a fund compared to the other criteria which can be included in overall policy or entity. The correct answer here is D. So I can see out of 6 responses, 3 have given the correct answer. Right. Let's go to the next question, question number 5. Right, I still have 5 responses. Let's see. Tracking array is particularly important in monitoring the performance of FTSE All Share Index Fund, European Dynamic Growth Fund, Global Growth Fund, Corporate Bond Fund. So again, these are all specific ones that we have discussed as well some time ago. So as you can see, the logical answer in the given one is FTSE All Share Index Fund. So I think I gave you a trick the other day, if you can remember. This is a kind of a, it's not a guaranteed solution, but in most cases it works. When it comes to FTSE All Share Index Funds, in most of the questions with this kind of practical answers, when FTSE All Share Index is given, most probably that is the answer, right? That's how it works, but no guarantee, but it has been the case as far as I am concerned when I saw the past papers. In almost all the cases, I have found that to be true. The correct answer anyway here is A. Right? Q5. A. Question number 6. Right, I have only 5 responses by now. Let's see what the question is. Frank is a portfolio manager and is considering an investment which, while not strictly forbidden by his firm, is marginally out of step with company policy. Frank's proposed action would benefit from risk review with other fund managers, peer review with independent risk managers in the firm, peer review with other fund managers, risk review with independent risk managers in the firm. Now first get the question clarified. Now you are a portfolio manager considering investment. Now you are saying that although this investment is not completely away from the policy, but still it's little out from your company's policy. That's not very different. So major, there's no major difference, but little away from your policy. Then that will have its own risks involved. So the action would be risk review with other fund managers. That is within the firm it might occur. Peer review with independent risk managers in the firm again, right? Peer review with other fund managers. You are looking at other institutions with other fund managers. Risk review with independent risk managers in the firm. So you can see A, B, and D, all 3 options, you are looking at internal, right? Because somewhat connected to the firm. Even second one, independent risk managers in the firm. So therefore, to get a better independent view of the matters, the ideal would be to get a peer review with other fund managers outside, right? So therefore, the correct answer is C. Let's go to the question number 7. Right, I've got only 6 responses. Let's see the last question today. Question number 7. What type of return does a coupon on a bond provide? Nominal, total, real, holding period. I think it's very clear and obvious. We discuss this. On the face value, right? When you on the bond nominal, what you get is nominal return, right? The coupon is a nominal return. So out of 6 responses, 4 have given the correct answer. Right. So we have done up to the 7th question. We will stop with that because it's 9:30. I think if you all can engage and go a little faster, we can finish this. I think we have a few more topics to go. Let's try to finish it faster, then you can get ready for your exams without a problem. So otherwise we are just taking time and then you can sometimes forget what we discussed earlier in the early stages. So let us try to finish these papers as fast as possible and then get ready for the exam. So with that, I'll stop for the day. I'll see you next time. Good night.
Good night, sir.
Good night. Good night, sir.